Everybody to Trade Like Nick for Thursday, May 20. Actually, what is today? May 20th? Um, t- Today, sorry about that. Today, we are going to talk about mastering the trade. Trading is very simple if you know exactly the process. So today, I'm going to teach you a lesson where you could learn to trade like a professional in three easy steps. So first thing I want to do here is go over what we're going to cover in this quick lesson. We're going to talk about finding the trade, building the trade, and then executing the trade. I'm going to teach you these three steps so that anybody can do it and begin trading confidently from day one. So let's go straight to the S&P 500 market. And I want to show you guys, update you guys what's going on in the portfolio. And we are up about $200, $330 for the day, right? Not too bad. And what we did here was we sold at 802. We sold the 73.95 put. And when you sell the put, you want it to stay above that. So if you look at the chart, it went way above that and we rallied all the way up to 74.65. See that? I sold it right here in the morning and then it went all the way up. And this is what I want everybody to take a look at. Do you see how the market went all the way up to 74.65 and then went right back down? Did you know that the options market predicted that? You guys want to see? This might blow your mind. So you can actually go in and take a look at what the market makers are doing. Because if you take a look here and we see that there was a lot of volume here at 74.65. I don't think you guys can really see that. Let me see if I can blow this one up a little bit bigger. So you'll see that image. Let me make this bigger here. Rotate. Actually, you know what? I don't think you're going to be able to see this image. But basically, what I want to point out was 64.65. See that right there? This is the one that had the most volume at 7 o'clock this morning, Pacific Standard Time. So by just giving you a brief glimpse of how to think like a market maker and how to think like a retail trader, a lot of retail traders were selling the 74.65 call. It only had like a 5% chance of getting here, but it went all the way up here and then it liquidated them and came back down. So what you could do here is sell the 74.65, and that's exactly what I did. So let me show you right here. You'll see at 8:13, I actually sold the 73.95. Actually, I bought this one to close for 50 cents. This is how you lock in profits, right? Because if I sold something for 220, right, the 73.95, and then I buy it back for only 50 cents, you can see that is where I make the profit. 220 minus 50 is $1.70. So that is $170 of profit. And because I have a couple of positions on here, right? I sold this one and I sold this one. I bought this one back to close. So let me go out and buy this one to close. So if I go in and create a duplicate order, initially I sold it for 220. Now it's going for $0, right? Because the spread is way down here. It has no chance of it getting back down here in the next 35 minutes. So going back to today's lesson, I'm going to show you guys a really valuable trading tip. In order to be a successful trader, you need three steps. Number one, wait for confirmation. So do you guys want to see me actually trade the futures? This is live day trading, right? If you type in MES, this is the actual futures index of the S&P. It's the micro futures. See that? See where it says micro, right? This means that this is a smaller version of the S&P 500 futures, which is the ES. And here, if you think, right, If I think that this stock is, or this index is going to go lower, right? If it's going to roll over here and come back down, I could actually, or let's say go up higher and break above 74.70, right? So let's just say I think it's going to go up there. I'm going to go in and say buy, single, and then I'm going to edit. And this is where I'm going to walk you through the 3-step process of executing the trade. You guys ready to follow me? So the first one says wait for confirmation. Price must prove it's going up. Then you trigger in. So this is what you're going to use a buy stop order. So this is a very advanced order that most people don't use. So what this means is you change your limit order. Limit means buy it at this price or lower. And right now, we want to use a stop order. This means don't buy it until it hits my stop price. So let's say we don't want to buy this until it hits 74.65, right? So this thing needs to hit 74.60. Let's go 66. If it gets above there, trigger me in. Once you click confirm and send, what this order does is it's waiting. See how it's just waiting to get triggered in? So you're not actually buying up here, because if I bought already, I'd be going down and I'd be losing money, right? I want to wait for the stock to actually prove that it's going to break out before I buy. So here, I'm going to put in another order to short it. Remember, you can actually short, you can bet on it going down. So I go single, and then I'm going to go edit. I'm going to say, you know what? Short it. If it goes down to my stop price of 74, let's say 74.61, 74.62. Okay. So I'm going to put 2 orders in here. One is to short it, bet it going down if it goes through here, and go long if it goes up through here. This is a key tip in trading because this forces you to be patient. One of the biggest reasons traders lose money is they're impatient and they just want to get in because they want the best price. But right here, I'm waiting for price to actually trigger me into the trade. That is the key word. I want to wait for price to trigger me in. Once I get triggered into the trade, then I know the probabilities are more in my favor because it's actually going in that direction. And then I enter. Because in trading, a lot of people will get into the prediction trap. They try to get in here predicting it's going to go up. But do we really know it's going to go up, or predicting it's going to go down? We don't know. We have to wait for the price to actually show us that it's going down. And then if I want to move it lower, I can move it lower right there. And so now I need this thing to clear these wicks before it triggers me in. If I want to get in a little bit early, I can move this Oh, testing, testing. Okay. So here, let me do this one more time. Looked like my mic was getting on the fritz here. So let me create a closing order and let's get out of this trade here. Because right now I am long one futures contract in the MES, which is the micro futures. So I'm going to sell it. There we go. It should fill. And let's say I think this market, there, I'm clear. So now let's say I think this market is going to bounce from here. I'm going to put in an order that says buy, and I'm going to change it from a limit to a stop. What does that mean? That means this has to actually go up and hit my price at 674.64. So if I click confirm and send, you can see that this order is waiting, right? This is why it's important to be patient and wait for the price to actually to trigger you into this trade. Give me 1 second. I got to make sure my mic is working properly. All right. So how much does it cost to open a position like this? I'll show you. To buy, you can see it costs $2,500 of margin or buying power effect. Okay. So as we wait, this is the key part three. Wait for confirmation. Then we bracket the order. This removes the emotion from the trade. Then you turn off the monitor. You walk away and you let the market do the work. You let the market do the heavy lifting, because this is where most traders mess up. They get into a trade and then they get emotional by staring at the screen. How many of you guys agree with me? Have you guys ever put on a trade and then all you do is you stare at the screen? But what good does that do? When you're staring at the screen, does it cause the stock or index to go up or down? No, right? So it's best to just turn off your screen, go walk away, go do a chore, and then whatever hits will either lock in your profit or you minimize and limit your losses. So here you can see we're up $6.25, right? This is just trade. Now we're only up 250, up 370. See how it's moving by $1.25? The reason it's moving by that is because when you trade the futures, right? The micro futures, it says every time it goes up, you make $1.25. If it goes down, you lose $1.25, right? This is how much it costs you to do this trade. You need to have at least $2,498 in your account to day trade this. And if you want less margin, right, you could actually ask to do intraday margin trading where they actually require less. You might only need like $500 to do this, depending on your broker. So now that we know kind of like how it's priced, you can see where we want to get filled. And to see what price we got filled at, let me just show you. If you go here into the order history, you can see we bought this at 74.64. So let me just put that in here. 74.64 is right here, right? We bought it right here. And here, let me edit this and go 74.64. Okay, that's how much we bought it for. So to do the math, this is how you figure out what your profit and loss is, right? Because if we bought it at 74.64, right now it's at what? 74.64.75. Notice how it's moving in 25-cent increments. See that? Now it's up 74.65.25. Every time it moves up 25 cents, you make $1.25. So look, see, we're up 250 here. It says that we bought it at 74.64. The current price is 74.65. So a full point, that's $5. Now it's $3.75. See how it's very little risk, very little margin, because this product that we're trading, the futures micro, is only 1/10 the size of the futures. So if I type in futures ES, watch. Oh, look, now we're almost gonna get filled here. Let's see if this thing gets filled. Right? We're up how much now? We're up $13.75, right? If we get filled, what is our order at? Our order is waiting at 64.68. So if we bought it at, okay, 74.68 minus how much we bought it for, 74.64, that is equal to 4 points. But because this thing makes $1.25, here, let me write this down here. This thing makes $1.25 per tick. So if it's 4 ticks, there's 25 quarters in a dollar. So that is 4 times 4. That's 16 times $1.25 equals 20 bucks. So if this thing hits my profit target, I'll make 20 bucks. So let's just give it a minute to do the work, and then I'll come right back when we're close to one of our targets. All right, see, notice how we're at where we bought it for. So our profit loss is only $1.25. See that? There's really not that much risk trading the futures MES if you trade small. And watch, so now it's down. See how it's down here? That means we're in the negative. We're down $7. Now we're down $10, right? I'm only risking very little money. And if I get stopped out, oh, watch. Boom, I'm stopped out, right? So what happens is, see how this order got canceled? Once this order gets hit, it cancels your profit target order. So therefore, we are now out of the trade and we lost on that trade. But it's okay because you minimize your losses, right? That's one way to trade directionally. If you want to trade the actual futures contract, which is the ES, you could do the exact same thing. Notice this chart is exactly the same. There's really no difference, right? The only difference is the leverage. Watch, if I try to buy it, now I need $25,000 right here. Let's just buy it here. And if it gets down to this price, get me in. But remember, we want to wait for confirmation. So let's say I got to put this as a stop order. And if this thing gets up to 60, oh, now I'm in, right? So now watch. You'll see that for the ES futures, if you trade it, look at this, it's $12.50 a tick. Remember, every time this index moves, it moves in 25-cent increments. That's what a tick is. A tick means instead of moving every penny like a stock does, right? This thing moves every 25 cents. So watch, this thing moves, you'll see it moves to 75 cents, it'll go to, see, $1. If it goes up, it'll be $1 and then 25 cents. So this just means, the tick just means every time this index moves, it moves in 25-cent increments. Does that make sense? So if it moves in 25-cent increments, every time it moves, you make $12.50 or you lose $12.50. But when you trade the ES futures, which is the most liquid futures contract out there, you have to have $25,000 in your account. Look at how it went up. You want to see how much our position is worth now? Look, we are now up $175. See that? Why? Because this has so much more leverage. Watch. We bought it at what price? So let's do the math here. If we bought this thing at 74.59.50, right? And it's now trading at 59.50 and it's trading at 62.75, right? So we can say, okay, let's say this is what, 4 points? There you go. 4 points away. Well, 4 points away, there's how many quarters are in 4 points? Well, there's 16 quarters, right? 25 cents. And then you multiply this by $12.50 per quarter every time it moves. That's how you calculate your profit target. So here, let's do that again. 16 ticks times $12.50 equals 200 bucks. That's why we get this number. Now it's going down a little bit because of what? The chart is now going back down. See that? Everything is calculated to the tick. That's what's beautiful about trading the S&P 500. Depending on how much leverage you want to use, depending on how much you want to accelerate your money, you can trade the ES, which is the S&P E-mini futures. You could trade the MES, which is the micro futures, which is a lot less, right? This is only $1.25, but the chart is all the same. Notice this is the exact same chart, right? It goes up here, down, went all the way down, went back up. Now, if I do the SPX, notice the chart. It's the exact same chart, right? This is just going up, but with the SPX, this is where you could trade options on it. You can actually trade options on the futures as well. So if I want to go in here, I can figure out what option do I want to sell. Now, instead of trading directionally, where I'm just buying and selling straight direction, now I can use probabilities and bets, because with options, they expire here in 15 minutes. When I do the futures, they don't expire. They do expire every, month, but there's no extrinsic value. There's no time value. You're just trading just like a stock. But here with options, what gives you, options gives you more options, get it? And you can buy and sell these with probabilities attached. See how there's probabilities? With futures, there's no probability. With stock, everything is 50-50, right? Because it either goes up or it goes down. You make money, you lose money. But here, because these bets expire, now there's a probability tied to each one of these bets, because there's going to be a winner and a loser by the end of the day. So let's just say I don't think it's gonna get above 74.50. I can go out here and actually sell the 74.50 right here, and I could sell it for $1.20. See that? And then I'm gonna go out and buy one for cheaper just to reduce my cost. I get a $1.15 credit. Now, this trade, as long as the index can stay below 74.50, which is right here, I can go and I profit a certain amount, right? I profit $1.20, 120 bucks. This is the beauty of trading. You can trade directionally with futures. You can trade probabilistically with options. You can buy options. You can sell options. It's all based on this stock chart. And whatever the chart does, you can position yourself to profit accordingly. And the one thing I want to point out, this might blow your mind here, but when you start to trade, there's this thing called open interest and volume. And by looking at this, you can see where retail traders are positioning themselves because at the volume 74.65, right, had 90,000 of volume, right? And in the morning, you can see that the volume starts to accumulate at certain strike prices. And then that's what happens with the market makers. They start to attack these retailers. 74.50 looks like it's going to be a pretty strong area of resistance. So if you think it can't get up here, then you can sell this bet and then collect the premium. So that's what we're gonna do for the rest of the 10 minutes, is see if this thing closes below. If it closes below, then this trade that I just placed is going to expire worthless. Right here, it's worth a $1.20, create opposite order. I'm gonna close this thing out if it gets down to 80 cents. So what this is a order that's working, that's gonna lock in your profits. Meaning I'm not gonna try to squeeze out the full $120. If I can buy it back for 80 cents, then get me out. See, right now it's only going for 95 cents. See how you make money here? You sell something for $1.20 and then you buy it back for 92 cents, you make the difference. And even though this is in dollars, this is actually $120. This is $100 because you have to multiply it by 100. So right now I can lock in this trade right now and make 20 bucks. See the difference between 120 and 100? I can make 20 bucks right now. But because I am gonna wait to see if I can buy it back here at 80. Let's see if this thing can close above here or stay below, right? So this is where a lot of activity is happening right now. Last 10 minutes of the market, people are buying, selling, and you just guess wherever you think, depending on your analysis, right? Do you think it's gonna get above or below? And there's a probability tied to it. Look at this probability, 74, 50, look at the probability move. If I just go probability, you'll see probability of in the money. This 74.50 has a 28% chance. Now it's 28.83. Now it's only 26, right? Why? Because every time this thing goes up or down, the probability of that bet is gonna change, right? Because the higher you go, the higher the probability, right? Now the probability is 29%, 30% that it might expire in the money. If we go back here, you'll see, right here, if this thing goes all the way back down, you'll see the probability drop a bunch. And then you can sell these probabilities. You don't have to wait till expiration. But here, we're just gonna wait and see what the market does, and you'll see the risk. And as we wait, let me show you another important part of trading, and that is risk management. A lot of people, they don't teach you this, right? Get set. Set stands for your stop, your entry, and your target. So in order to trade, you always have to trade small and trade within your risk parameters. So the first step is, let's say you enter a trade. Let's say you buy something at $100. Okay, that's your entry price. And remember, you use a buy stop limit. This means wait for it to hit 100 before buy it. And then you're gonna put in your stop loss. Let's say your stop loss is gonna be at $95, right? So if you buy something at 100 and then you put a stop loss at 95, and then your target is at, let's say, 110. So now this is how you put it in your broker statement, right? You enter a buy stop limit, that's step one. You put in your stop loss, that's step two, right? A sell stop, and then you put in a sell limit order for your profit. This is risking $10, no, you're risking $5 to make 10. So this is actually a 2-to-1 risk to reward ratio. And that's what you want. You want an asymmetric profile where you're risking just $1, or in this case, $5 to make $10. Right? This is get ready, get set, and then you got to say, how many shares am I going to buy? So this is a powerful formula as well. Let's say you have a $10,000 account and you're willing to risk 5% per trade. That means you're willing to risk $500 per trade, because your portfolio, right, is 10,000 and you only want to lose 5% if you're wrong. Now, you take this amount, 500. The second step is to determine your trade risk. What is your trade risk? In this case, if we buy something for 100 and then we sell something and when it hits our stop loss at 95, what is our trade risk? Our trade risk in this trade is now $5, right? This is how much we're risking. So if our trade risk is $5, then how do we determine how many shares we can buy? Well, the math is easy. You take the amount you're willing to risk in your portfolio, you divide that by how much you're risking on this share or this stock, and then this tells you how many shares you can buy. Because now I can buy 100 shares. See that? And if I get stopped out, well, 100 shares, and I'm only risking $5 per share, then I can actually buy 500 shares. So now you put in 500 shares, right? And you're risking $5 per share. This will then tell you that you have, and your profit target is what? $10, right? So now you just put it in your spreadsheet and oh, the bell's about to ring. We got 5 more minutes in the market. So here you're risking 500 shares times 10. Wait, 100 shares. What am I doing? I'm like, well, 500, that's not a, it's 100 shares, right? Because 500 divided by 5 is 100 shares. So if you have 100 shares and it hits your profit target of $10, then you make a reward of $1,000. Now you have a 2-to-1 risk to reward ratio. So that is how you do it. Step 1, always determine how much are you willing to risk in your portfolio. If it's 5%, that's $500. Step 2, then you got to determine how much are you willing to risk per trade. If your entry is 100 and your stop loss is at 95, then you're risking $5 per share. To determine what your proper position size is, then you just figure out 500 total risk divided by $5 per share. That tells you how many shares you can buy. That, folks, nobody teaches in their courses. This is the most important lesson that you need to learn, because without proper risk management, without knowing what your stop loss is, what your profit target is, what your risk to reward is, then how can you figure out how many shares you can buy that is within your risk parameters? So let's see what the market is doing right now. It's going back and forth. We got, what, 3 minutes left? I'm gonna let it go and we'll see together if this trade makes money or not. All right, so here, if we bought it here, notice this position is up 282. We're up $732 just on these positions alone, right? And the ES is up $462. So why? Because look, we bought one contract. How much did we buy it for? We bought it for $74.59. It's now currently traded at $74.66, right? That is a $375 profit right there. See that? This tells you per tick, it's gonna go up $12.50 every time it ticks up or down. See that? See, it's $412.50, $425. Notice how it's going up by $12.50. Why? Because every time it goes up, you're making $12. Here, let's lock in this profit, right? If I want to close this trade, I just right click, create closing order. I'm going to sell it. And then we'll lock in the profits right here, right? And then boom, this will fill and then it'll close you out. Right now we have one order working, right? It's working right here. If it's not filling, I'm gonna change it, cancel, replace, and then I'm gonna get in for cheaper, sell it for cheaper here. Because limit means there, I'm out, right? So boom. Now this trade is closed, and the only other trade that we have left on is selling the 74.50, 74.75 call spread. So here, are we getting up there? Here, let's go to the SPX. You just saw me day trade the futures. Now you're seeing me day trade the options on the SPX, right? We sold the 74.50. If this thing closes anywhere above, here, I'm gonna close that. If this thing closes anywhere above, I'll lose. But if it closes below, I win. So we got how much? 44 seconds. Let's see, is it gonna close 74.50? See, watch. This order here, I'll show you how much it's worth, right? It's got 3 points to move. We got 33 seconds, folks. Let's see, is it gonna close below 74.50? If it does, I collect the whole thing. 24. See, watch here. Let's see how much is it going for right now. You can actually see if I created that exact same trade, right? It's barely going for anything. See, it's only going for 10 cents right now, right? So this trade, let's see, it's gonna close worthless. What's gonna happen in the last 5, 4, 3, 2, 1? Boom. The market stopped. It closed below 74.50. So this trade, remember this trade here where I sold the 74.50? I collected $1.20. I just made $120 in that trade. Because look, if you go here in the SPX, just trading these options, right? I was able to collect almost $450 worth of bets. This is how you can trade the S&P 500. You could do it betting on the options, trading options, selling them. You could do it on the futures, and you could do it on the micro futures. There's so many different ways. So that's what I wanted to kind of show you guys. Hopefully you guys learned a thing or two. If you guys like what you've learned, hit that subscribe, give me a like, give me a comment what you want me to analyze next, and we'll become better traders together and accelerate our wealth. All right, folks, everybody, remember, trade with discipline, trade responsibly, and trade like you mean it. Peace.